Some investors wait for the perfect moment to invest, believing that one big decision will determine their financial future. Others take a slow, steady approach, hoping that consistency will outweigh timing. And then there are those who do nothing at all, paralyzed by indecision. The truth? Every day you delay investing is money left on the table. The longer you wait, the more you lose, not just in returns, but in time, which is the most powerful factor in wealth creation. The biggest debate in investing is whether to invest through a systematic investment plan, SIP, or go all in with a lump sum investment. Some say SIP is the safest, most disciplined way to build wealth. Others believe lump sum investing accelerates growth and maximizes compounding. But which one actually works best? The answer isn't as simple as choosing one over the other. It depends on your financial goals, risk tolerance, and market conditions. Hi, I'm Jiten Modi, your personal finance strategist. Over the years, I've helped countless individuals eliminate financial stress and build wealth through smarter investment decisions. And one of the most common questions I hear is this: should I invest through SIP or make a lump sum investment? The truth is, both strategies work, but only if applied correctly. If you don't understand when to use which, you could be leaving lakhs in potential returns on the table. In today's video, I'll break down the SIP versus lump sum debate, show you exactly when to use each strategy, and help you make a decision that aligns with your financial future. By the end, you'll have absolute clarity on which approach suits you best, how to optimize your returns, and how to make your money work harder for you. Let's dive in. When people talk about SIP and lump sum investing, they often think it's about choosing one over the other. That's where most investors go wrong. The decision isn't about which method is better, it's about which one fits your financial situation. SIP is like planting a tree and watering it every month. Small, consistent investments grow into a strong financial foundation over time. With SIP, you invest a fixed amount at regular intervals, which means you don't have to worry about market fluctuations. If prices are high, you buy fewer units. If prices are low, you buy more. Over time, this strategy averages out the cost and reduces risk. Lump sum investing, on the other hand, is like planting an entire forest at once. You invest a large amount in one go, allowing your money to start compounding immediately. If the market is at a favorable level, this can generate significantly higher returns over the long term. But here's the catch: what if the market crashes right after you invest? This is why lump sum investing works best for those who can stay invested for the long term and handle short-term volatility. Many investors believe SIP is safer, but is that always true? Let's compare both approaches with a real example. Suppose you invest 5,000 rupees per month in a SIP for 10 years, in a mutual fund that generates an average annual return of 12%. By the end of 10 years, your total investment would be 6 lakh rupees, but thanks to compounding, your corpus would grow to approximately 11.5 lakh rupees. Now, let's assume you had 6 lakh rupees to invest upfront and you invested it as a lump sum at the beginning of the same 10-year period. With the same 12% return, your corpus would have grown to approximately 18.6 lakh rupees. Clearly, lump sum investing has the potential to generate higher returns, but only if the investment is made at the right time and held for the long term. The biggest mistake investors make is trying to time the market. What if you invested a lump sum just before a market crash? Your portfolio would take a big hit, and it could take years to recover. But if you invested in a SIP, you would continue buying at lower prices, benefiting from market corrections instead of fearing them. So how do you decide? It comes down to your financial situation. If you have a large amount of money sitting idle, and you don't need it for the next 5-10 years, lump sum investing can be a great way to maximize returns. But if you are investing from your monthly income, SIP is the best way to stay disciplined, avoid emotional decisions, and benefit from rupee cost averaging. A combination of both can often be the best strategy. If you receive an annual bonus, invest part of it as a lump sum and use the rest to increase your SIP contributions. This way, you take advantage of both market growth and risk diversification. There's also a smarter way to invest a lump sum without taking on too much risk: systematic transfer plans, STP. Instead of investing the full amount at once, you park your lump sum in a debt fund and gradually transfer it into an equity fund over time. This balances risk while still allowing you to deploy capital effectively. Now that you understand SIP versus lump sum, the next step is making sure you are investing in the right mutual funds. Because even the best strategy won't work if you are investing in the wrong funds. Many investors blindly choose mutual funds based on past performance or random recommendations. That's a huge mistake. You need a structured approach. Choose funds based on your investment goals, risk tolerance, and time horizon. For long-term growth, focus on equity mutual funds. If you want stability, mix in debt or hybrid funds. And always check key factors like expense ratios, fund manager performance, and historical consistency before making a decision. If you're still unsure which strategy suits your financial goals, don't leave it to guesswork. Book a free clarity session with me today, and together, we'll create a personalized investment strategy that aligns with your income, risk appetite, and long-term vision. If you prefer to learn at your own pace, download my free ebook, where I break down investment principles, fund selection, and wealth building insights so you can make smarter financial decisions. And if you want to stay ahead with real-time investment insights, join my exclusive WhatsApp community, where I share expert tips, updates, and strategies to help you grow your wealth faster. Your number stays private, but your learning becomes personal. The biggest mistake you can make is waiting. Every month you delay investing is another missed opportunity for compounding growth. A one-year delay could mean losing lakhs in future returns. The best time to invest was yesterday. The second best time is today. Take action now. Click the link in the description to book a clarity session, download the ebook, or join my WhatsApp community. Don't let indecision cost you your financial future. Your wealth building journey starts now.